Hello everyone, my name is Wei, and today I will be presenting on the topic of stock options contract, specifically how call options can be used for value investing. Please check out our other videos to get the basics of how options contract works. And without further ado, here is call options for value investors. Stock investing is about being a partial owner of businesses by buying companies' stocks. Being a partial owner ties up a lot of capital very quickly. And the more businesses you want to invest in, the more capital it ties up. With introduction of options, people can hold a single contract with notional value of significant numbers of shares with just a fractional cost of the actual investment. The ease of leveraging makes options contracts extremely appealing for speculation. And it is because of heavy speculation, options contracts have gotten such a bad reputation among long-term investing community. But I want to remind everyone that an options contract is just a tool, and it is up to the individual investor to use the tool that fits their investment needs. And just because many people are speculating using options, it does not mean you should. So, how can an individual take advantage of call options contract as a tool for value investing? Personally, I believe there is only one situation where call options contract should be used for value investing, and that is to plan a future purchase. Here is an example. John has competency evaluating a growth company XYZ. After thorough analysis, John really believes this company is an unfound gem, therefore undervalued. John would really like to make a purchase of the shares today, but it takes a month for John to have his cash available. So John will buy in-the-money call options contracts by paying a small fraction of the cost of actual purchase, with expiration dates on the week that his money becomes available. On the day of expiration, three things can happen. Stock price can be above the strike, at the strike, or below the strike. Let's examine those three scenarios. If the price is above the strike, John exercises the contracts and gets the shares at the strike price. If the price is at the strike, John has to decide whether or not to exercise the contracts or to let the contracts expire. If John's valuation has not changed in that month, John will still buy the shares either through exercise or buying the shares from the market. Now, if the price is below the strike, John will let the contracts expire worthless and buy the shares off the market at the lower price, if the valuation has not changed, that is. In-the-money call options contracts give John the ability to plan ahead, and also give him the option to decide on the purchase if valuation changes in that time period. Here's the further analysis on John's options contracts position. So why did John choose an in-the-money strike? Recall from previous video that contract price equals to intrinsic value plus extrinsic value. By choosing in-the-money strike, John can maximize the intrinsic value and minimize the extrinsic value. By buying those contracts, it allows John to plan a purchase ahead of the time and lock in an entry price. As a bonus, in-the-money contracts have built-in hedge. Recall the profit and loss graph for all call options contracts. If stock price falls below the strike, John will let the contracts expire worthless, with the cost of contracts as maximum loss, instead of accruing additional loss if John had owned the shares outright. In the next video, I will present on the topic of call options for speculative investors. Thank you so much for watching. In this channel, we present on investment topics with plenty of examples. We cover investment terminologies, value investing, speculative investing, investment mathematics, and investment tools. Share, thumbs up, and subscribe if you like the video.